Hi, everybody. Welcome to the Middle Class Investor. This is Seth Martin, your host. It is August 29th, so about 12:30 in the afternoon, and thought I would go ahead and make a video of this week's market action. We had a pretty, let me put it on a weekly, we had a pretty active week. You can see there from the screen here, the market opened right here at this line at 1962, sold all the way off down here, and then ran all the way back up here and closed at 1988 for the week. This is now that the market has broken out of this range and out of this pattern, it's going to be a little bit easier to talk about what to expect in the market from week to week, at least from, say, month to month. Week to week sometimes is difficult, but month to month should be a little bit easier now that we're out of this range. Just to recap, we had a huge rising wedge that went all the way back to the 2009 lows, but it broke out here and then the market resumed higher. So we kind of abandoned that particular pattern, but then that became the start of a new rising wedge. And of course, you can see here last week the market broke out of the wedge and immediately sold off. But we have not yet come to the October lows, which is what I told you, that the market likes to revisit the origin of the pattern, and that is, in fact, the origin of the pattern in this case. So, which tells me we still have some more downside. We could get some of that downside as early as next week. And look for that market action to take us into this blue box area at least. Could take us lower. I don't know. I don't think the odds are very good at this point that it's going to take us lower, only because the meat of this particular move is pretty obvious. You can see the meat of this move is right in here. Now, had this been kind of grinding its way down to here and then it bounced and we hadn't had the meat of this particular move yet, then I would say, yeah, the blue box probably wouldn't hold up. But I think the market will probably trade down next week and the week after into that blue box. And then we should get a big rally. We still have a gap here above the market at, let's see, what is this? To close the gap, we need to get to 2,070.53. So 2,000... I'm sorry, that's not right. 2,035.73. So 2,035.73. And let's put something there that'll make that easier to see. It's hard to zone down and get right on 2,035. There we go. So it looks to me like the market's a little bit out of steam this week. So I think we'll probably revisit those lows before we travel up and close this gap. You might get something that looks, kind of a wind its way down into this area. And then we'll get it'll be a pretty violent move back up, like so. And should happen fairly quickly, kind of like this. So, this is 1 day, 2 days, 3 days. Probably talking about 4, 5, 6, 7, 8, 9. Maybe in about 2 weeks, we should be looking to close this gap. And then it's going to be very critical to see what happens in the market in and around this area. Does it continue to grind its way higher and then start making higher highs? Unlikely, I think, at this point, because, and I'll show you a longer term trend here in a minute. I think what we should be looking for is the market to roll over. And this is probably, if you want to get out at good prices, this is what you're going to need to be looking for. If you need a little bit more evidence, certainly if this low, after we make this new low, if it gets taken out, then I think that's all the evidence you need to step aside and let this bear market play out. It should be no surprise, really, that the market trend has come to an end. The bear market's been going on now for almost 7 years. Let's pull up a 10-year chart, and these vertical lines here, they're just the end of the year, so it's easy to see where the end of the year was. Actually don't have a trend line. I have a trend line above, but not below. Let me just throw one down real quick. So if we just take a line and we draw it underneath as many, I like to touch as many of the lows as I can. So I've got a touch there. I've got a touch right here. Let me zoom in a little bit so you can see the touch here. Actually, I went through that touch a little bit. Yeah. I drew the line a little bit too high, but let's draw it right there. Now let's zoom in a little bit. Clearly you can see this trend line has been broken. We usually get, when it's through going down, we usually get some sort of retest of the trend line. And it may not go all the way to the trend line. It's just a zone, right, around the trend line. And then we would look for the market to roll over and resume the downtrend, new downtrend. So we had a pretty big topping action in this market. Like I said, I'm kind of shocked that it took as long as it did. I mean, this pattern goes back to October 2014. And you can kind of see how it just arches over. There's like a, you can kind of see how the market kind of does this and then just kind of rolled over and then really got sharp here. But it's been going on for a while, and you might have kind of gotten a tone from me that I was getting a little bit more bearish. I don't like to get into predicting, especially when I'm talking to other people that don't watch the market as closely as I do, because the reality is it's very difficult to predict the market. Certainly from day to day, it's difficult. The bigger picture is usually not as difficult because it's just, I don't know, it just kind of jumps off the page at you if you step back and look at a real big picture. If you look at like a 20-year chart, let me take off all the, I'm going to take the, all the drawings and stuff off so you can kind of see what I'm talking about. If I can find there it is. Couldn't see so I'm going to hide all the drawn items. And let's hide the studies. So you can see we had a big move here and then a pullback. Okay, this is a monthly chart, so each one of these bars is a month. So we had a big run up in the 90s and then a pullback. Another big run up and then a pullback. This run up was pretty big. Now we had this little intermediate pullback here. But if you measure these, you start measuring the length, how many weeks and how many months this is. This one's kind of overdue. And it's probably overdue because of all the quantitative easing, the Fed's activity in the marketplace. But it clearly, you can see it kind of starting to roll over there. It's not quite as sharp as this, but this last month was very sharp. So I don't know. To me, it's not that big a surprise. I mean, maybe to other people, it's more of a surprise. Don't know. We'll leave our drawn items on there. I'll take the. I might put the studies back on there if we start looking at 50-day moving averages and whatnot. Let's look at the VIX. So the volatility spiked way up. I mean, if you look at the volatility here, it spiked to levels that we hadn't seen since 2011, and this was 2011. Time frame is when Greece was really first going through that big scare about default. So we jumped up to those levels in just a couple of weeks. I mean, really just this week and this past week, shot us all the way up in here to the above 50 mark. And of course, volatility has since collapsed since we had this big move up. But once volatility kind of gets up in this area right here, you probably won't see volatility back down in these areas. If you kind of think of it like you've kind of got a zone right through here. Whoops. Kind of got a zone right through here where volatility has been, and now we're above that zone. You'll probably see volatility stay above that zone. So we'll probably see volatility kind of stay in an area, around here and maybe even above there. So we'll see volatility come in and maybe bounce back above this area and then come back down, and then it's kind of stay in this area, and then there'll be spikes as this bear market. It's still a surprise to a lot of people, right? They're blaming it on China, and it's China's fault, and so therefore, if it's somebody else's fault, once these American investors kind of get their heads back together, then the market should come back. That's kind of the rationale around it's somebody else's fault. If you look at, let's look at the interest rate. I think the interest rates made an interesting move today, or this past week, a pretty strong move. Let's zoom in and we'll look a little closer at this. We're still, to be sure, we still want to see a close. This now is the low candle right here. So we next week we want to see interest rates close above this high right here. And then I think for the intermediate term, you can say interest rates have stopped going down in this pullback, which is a little deeper than I personally thought it was. The interesting thing is it pulled right back into this blue box that we had put on, I don't know, a long time ago. Whoops. I did that again. Sorry about that, guys. Let's see. I need to go to charts. There we go. So we had put that box on. I guess off this low here, I'd put this box on, and we tagged it with this that interesting day where we had the bond market really rally. There was like scared. You had it really rally and then sell off. And I thought that was the low. I thought it was done at that point, and we were probably going to start making higher prices. But it came up, it rolled back down, and even made a lower low, and then kind of ground higher from there. So I think this low is probably, well, let's put it this way. I'm as confident about this low as I was about that low. So could I be wrong? Sure, but it did seem to stop going down. If you look at this down channel, this pullback channel, we broke out of that channel and we pulled back, and the channel more or less held the pullback. So this is pretty typical market action. You get a breakout from a channel, you get a pullback, and then the market lifts from there. So, I feel fairly confident about it. But, I felt confident about this one too. The bottom line, the bigger picture. So a lot of what I'm doing, everybody's heard the term, someone can't see the forest for the trees. A lot of this talk right here is the trees, okay? I'm trying to give you, I'm using a lot of this talk of the trees to kind of help you feel more confident about what I'm saying and things like that. But the bigger picture is bonds are yields are going up, bonds are going down, okay? And so the big picture is you need to move yourself out of bond funds, because in a rising interest rate environment, and I know there's a lot of talk about the Fed, and we've talked about this before, but the Fed does not set interest rates. It only sets the rate to banks, and it's an overnight rate. They don't set rates in the bond market. Now, in recent years, with this QE activity, which is very unprecedented, okay? I mean, you used to be able to say the Fed doesn't set rates, and that was that, okay? Now you have to kind of qualify it with what I'm fixing to qualify with. This whole intervention into the bond market over the last several years now does have the Fed playing in the interest rate market. And they may attempt to try to hold interest rates down again. But I think that attempt will be futile. I don't think they're not going to be able to print enough money to keep this interest rate market from going higher. And the simple reason is there's a lot of people holding our bonds all over the world. And when they need cash, look, China's a great example. China is trying to prop up their markets. Now, should they be doing that? Absolutely not. But the fact is they're doing it. And where are they getting the money to do that? Well, they can only get the money from a handful of places. They can borrow it, they can tax it, they can print it, or they can sell something they already have, U.S. Treasuries. Okay? So they can sell U.S. Treasuries and take that money and try to prop up their markets. All of it, none of it's going to work no matter what they do, but you can see how they would definitely attempt to do that, and it makes a lot of sense that they would sell something they have, especially if they don't have a lot of confidence in it anymore. Sell these treasuries and start buying their stocks. So there's a lot of sellers out there, and a lot of sellers of bonds. And this interest rate is going to start climbing this little pole right here pretty soon. Now, once it kind of breaks out, once we can confirm this is the pullback, I'll put some estimates on the chart about how high I think they're going to go in this particular move, and then overall with the larger move, how high I think they're going to go. Anyway, that's to come though. We need a little bit more evidence on the chart. And then we can start taking some key levels and making some measurements. Let's look at Germany, because Germany is broken. You know, we had talked about Germany making it up here. Let me zoom out a little bit. We've got this zone that we made up here above the market. Germany came up, pulled back to the trend line. So here was the trend line for Germany. This blue line right here, which I'm going to make red. So pull back to the trend line, came up, made a lower high, and rolled over. Now, right now you can say, well, Germany's in a sideways trend. And so what does it need to have a trend change? Well, it needs to break this. So it would need to come down here, let's say to here, to the box, and then rally back up, but then to another lower high again. That would be trend change in Germany. So look for that to play out over the next several weeks and months. And again, this technical analysis stuff, it's not there's nothing that works 100% of the time, but really it tells you all you need to know about what the buyers and sellers are doing and what the demand for certain equities is. When price goes down, the demand for those equities is falling. When price goes up, the demand is increasing. Japan to me looks broken. Maybe. I mean, it could still, excuse me. It pulled back into the meat of this, and that's real unusual this late in the move. Usually not a very good sign. On a shorter term basis, there's a lower high here. Here's a pretty important low, because this was the last low before we got back into this mess here. And the fact that it broke down through that pretty sharply all the way down to here tells me that this trend is probably broken. To officially say that, it probably needs to break down through this area here, but we might get that in the next move up. Japan is probably, all these markets are probably trading very similarly right now. So Japan had this little rally. It's probably going to have a pullback to a lower low, then a rally potentially even higher. but maybe not high enough. Maybe something like this. And then on that move, you might see it break this low. So, but Japan looks pretty broken. Certainly wouldn't be long Japan right now, except for a trade. The UK has been broken for some time. Look like this. Looks like it's got a little bounce in its future, and then maybe a rollover and back down. I guess that's about it for that group. Let's look at the dollar. Last week we drew this support box here below these lows, and we said, likely the dollar is going to revisit that area. We talked about how this looked like this could have been the pullback, and then we were going to make higher highs and everything, but it did roll over and come back to retest this area. That's not very uncommon at all. The market, a lot of times, if it puts in what looks like a low, a lot of times it will come back and retest it. But you can see right there that the wick of this bar here, it did get into the little yellow zone and recoiled away from that, pushed away from that. So we expect the dollar to, I don't know, we could draw another box below this low. The interesting thing that's difficult right now about the dollar is gold seems to have put in a pretty important low. So these really should be moving opposite one another. And for me to talk about this as a new low for the dollar, I don't know. It's hard for me to believe just because gold looks like it's put in kind of a real low. So why don't we look at gold since we're talking about it? I think gold's low is more substantial, only because the pullback has been longer and more pronounced. I mean, this is basically a 3-year pullback. And so we've got this low here. We had a real strong rally off of it. I think gold's probably going to move up into these longer-term moving averages way up here before it rolls back down again. I think gold is just looking like it has more upside potential, which has to mean that the dollar is either going to trade sideways or go lower. So I don't know. To me, it's just a little bit confusing right now. The dollar's not playing along very well. So, but if you laid the dollar chart over this, there's huge periods of time where they don't play well. But the bigger picture is, the dollar's, is going to rally to new highs probably, and then pull back, maybe go all the way back the other way and make lower lows. I mean, the dollar, you can envision a situation where the dollar is going to come under pressure at some point because our debt is just so enormous, and certainly we can't pay it back. So that's eventually going to come to cause money to leave the U.S., which is going to lower the value of the dollar and raise interest rates. So we've already kind of see the raising of interest rates starting to happen, but the dollar, it's not as obvious yet as to what's going on there. So let's switch to NinjaTrader and look at oil. This is a weekly chart for oil. You can see we had the highs back here in September of last year, and oil rallied down, pulled back, real strong decline, and then kind of almost got up here into it did get up here into a support off of this pivot right here. You can see that was if we go to a daily, for example, you'll see that. You can see, well, you can't see because I haven't gone back far enough. Yeah, so you can see here off this pivot. Actually, you can't really see that because if I were to draw one there, it won't be high enough. So, yeah, well, it is high enough. You can see it got right into the meat of this decision point off of this previous high here, and then rolled over. And it rolled over really hard. I mean, I think this move down here really surprised a lot of people. the fact that we're getting a bounce right here kind of makes me wonder if we're going to get new lows in oil. If you look at like a monthly chart, I don't think it goes back far enough, but it doesn't really go back far enough. You can see that maybe this decline is not over, and that there's some more downside potential. But this chart, I mean, definitely oil is going to go to this zone, even if it goes lower from here. If oil decides to go lower, it's going here first. Okay, so it's put in a good bottom for now. What was that? At 37.56. And you're going to see it rally in fairly short order, probably over the next month or so, maybe 6 weeks. You're going to see oil rally into this decision point area, probably get a little soft and roll back down. And the question is, how low will it go when it rolls back down? Now, the 2008 low is the most recent, very large cycle time low, and it was at $32.58. We're probably going to go below that. It's my guess. I don't have the data back that far right now, so what I'll have to do is pull up a longer term chart and look at a decision point off of that 2008 low, and then that'll give us a target, probably I'm guessing around $15 to $20, but don't know for sure without looking at the chart. So maybe that's something I'll put on my to-do list. We'll do next time, so we can have that to look at. Let's look at the DAX. We already looked at Germany, but if you were to look at, this doesn't look as bad as the MSCI chart. To me, this looks like this could rally. Now, the question is it going to rally, to new highs or not? If I were trading the DAX, probably what I would do is take a deep, that's the same DP. So I would look for the DAX to move to just the bottom of this DP here, 12,118. I doubt the DAX, given the way the global markets are right now, I doubt that it's going to make a new high here. This is probably the high for the DAX for the intermediate term, and probably not going to see this DP here. Probably only will see this one. Let's see what else we have here. We've got the FTSE. Same thing with the FTSE. We've got this DP here. I would say, the FTSE, you might see the FTSE get just above this 68 area, right around the 68 area, and then probably roll over. The FTSE's been below the trend line for a little bit longer and is showing a little bit more weakness than the DAX. Some of you might be wanting to know, well, how do I take advantage of, the bear market? If I'm convinced, as you say, stocks are going lower for the next year or so, how can I take advantage of that? Well, an ETF it's a double, it's an ultra ETF, but you can go to Google and just type in bearish ETFs or something like that. ETF stands for Exchange Traded Fund, and these funds, they trade just like stocks, so you can buy them just like you're going to buy a stock. But in this case, you can see during last week's turmoil, as the S&P 500 sold off, the SDS went up here to almost $26 from basically $20. So now, because it's a double, so if the S&P 500 goes down 10%, this is going to go up 20. But there are a number of instruments out there that you can invest in if you are convinced that the market's going lower, or you feel like it's going to go lower, or you're listening to me and you like what I have to say, and so you're going to follow along with that. You can trade things like the SDS, there's the Nasdaq has them. If you want to trade in the direction of the market, so if you just thought the market was going to go up, you would buy the SPY. The SPY is the S&P 500 ETF. There's one for the NASDAQ called the QQQ. There's one for the Dow called the DIA. But for every one of these, there's one that goes the opposite direction too. And you can go 2 times the opposite direction, 3 times the opposite direction. So you can use a little leverage and just buy stock. So I don't know if that's interesting to anybody out there, but I thought I would mention it because it's kind of a bummer to, it's great. You feel great that you're on the sidelines. You're not losing any money if the market's going down, but you kind of feel like you need to be, taking advantage of it. And of course, the way to take advantage of it is you can look at these ultra ETFs, and there's a whole slew of them online. You just pick one that you like. Now, what I will tell you, let me give you a pointer here. I'm going to type in the SDS. One of the reasons I trade the SDS is because of the volume. In fact, let's just look at, let me pull up the SDS here, and let's put my volume back on. If I can find that. Why am I having so much trouble seeing that? There it is, quick toggles. Let's put our volume on. You can see here, the SDS trades 152.4 million. On this day right here, on this week right here, it traded 152.4 million shares. Normally it trades around 50 million shares. That's plenty liquid, okay? If you look at the SPY going in the up direction, the SPY trades, these are billions. So this is 0.5 billions or 500 million shares. If you look at the SSO, that's the double up, for the S&P 500. It's trading 40 million shares a day. Those are plenty liquid. You just want to make sure that it's trading, whatever ETF you buy, you want to make sure it's trading at least 1 million shares a day, because you want to be able to drop in and out of the market as we identify these levels. You don't want to, you don't want to be a seller and then not be able to sell because the markets aren't liquid enough. So stick with the big ones, the high volume ones, and you can even, in your Google search, you can even stipulate that to make sure you don't get any low volume ETFs that you really don't want to trade. So let's wrap up and go back to the S&P, the S&P 500, and let's talk about next week and what we're likely to see. Again, we've already talked about this, but I just want to reiterate because this is where the rubber meets the road, so to speak. You can see here we got a new high. Now this is something when you start getting to the top of a trend. Okay, now I'm talking about a shorter term trend. The bars start getting shorter. Okay, you get these real long ones at first and then they start getting shorter, and then you might get one. We could get one that just looks like a cross, even like this. It might look something like this. Okay, when you start getting these lower range bars like this, that means the trend is coming to an end. So this is where you would want to, somewhere in here. Now, if you wanted to be sure and you wanted to wait for confirmation, you'd wait for a bar. Hold on a second. You'd wait for a bar that looks like, let's say like this, where it closed right here. So here's the high day right here, and here's the low of that high day right here, right? So you wait for a close below that, and then you enter. And then now, look, if this comes down and makes a lower low, which it should, the market's at 1988. Let's say by the time you enter, it's 1980, 1975 even. Okay? And let's say we're going to trade it down here to new lows, which is, 1850-ish. So you're talking about a 100-point move. You're basically talking about the opposite of this move. So this move right here is from here to here is 6.75%, and so you're talking about going 6.75% the other way times 2. So you're talking about making a 12-13% gain just by trading the SDS back to a new low and then you step aside, you get out of it. Now, so let's talk about the way the market is likely to move over the next 3 weeks. And I want you to just come back to this section of the webinar and view it again so that you can review this as you need to. Maybe we get something like this on Monday, okay? This is all just guesswork. We don't really know. But this is what you should look for. And you want to look for a close, okay? Now we're going to look for the market to make its way down to a new low down here, below this low right here, okay? This is where you would, so somewhere in here you'd buy your SDS, somewhere down here you'd sell your SDS. Maybe you're ready to go long. Maybe you want to do the SSO, which is the double for the upside, okay? So same kind of deal. You get a maybe a short range bar that looks like this, and maybe even one that looks like this with a real long tail on it, and maybe a small, maybe something like that, okay? And then you want to look for a close. So now we would have a close like this. Now that I've got a close above this low's high day, or this high of this low day is a better way to say it. Then I want to look for the market to go back up. Now this is going to be a pretty rapid move because these moves off the bottom always are. And you want to look for like a DP area just off the previous high here in this area here. And this is where the market would stop going up for some period of time. And then, like I said, we might get a little pullback here, something like that, and then something above that gap. Now, once it turns over from there, that's where you really want to be in your SDS, because the next potential low, and this is where it's going to get very, 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 very violent. I mean, you're going to see moves. It's going to look like 2008 probably, but maybe it could be a little bit worse. I mean, it's hard to really predict that, but these moves are going to be ginormous. And I guess I can tell you a little bit about how we do that. There's something called Fibonacci, and I need to do a little, maybe I always keep saying maybe I ought to do a little program on Fibonacci, but Fibonacci was a mathematician. You can look him up on Google, and he figured out an interesting ratio between numbers, and it starts with 1, and so it goes 1, 1, and then 2, and then you add the 1 and the 2 together, and you get 3, and then you add the 2 and the 3 together, and you get 5, and you add the 3 and the 5 together, you get 8. Anyway, the ratio between these numbers, any two subsequent numbers is, or if you skip a number, the ratio between those numbers is 0.618. And as you go out into infinity, and they're irrational numbers, and so as you go out to infinity, at first it's like a 0.629 or 6.3 something, and then eventually, as you go out to infinity, it approaches this 0.618 ratio, and it's just a unique number. It's known as phi, and there's all kinds of interesting things about this number and human behavior, the way our bodies are made, the ratio of your whole finger to just a segment of your finger is 0.618. The ratio from your wrist to your hand to your wrist to your elbow is 0.618. All these ratios they're found all over your human body, all over just all over nature in general. And somehow this guy figured this ratio out, and anyway, it works somehow in the market too. I don't know how it works, but it tends to work. I could show you some examples. I don't have any ready today. I could show you what I was looking at on a really short-term chart during the week. So I'm looking at this move up here. Now, we don't know just yet, but I was looking at this move up here, and you can kind of see this overlapping action. This is very corrective. And then you get this move here, and then you have this little move here. So you get this rise and then a pullback. So what I'm going to do is I'm just going to measure using Fibonacci, okay, from the top of this rise to the pullback, okay? And I'm going to show you something. Whoops, put that right there and click it right here. And what you'll notice, oh, I don't have it on this version. Well, I don't have it on this version. It's kind of a bummer, but I guess I can put it in there real quick. On my other, this is a paper money account that I'm looking at right here, but on my live trading account, I have another number here, which is another Fibonacci number, 377. Let me redraw this. And so if I go from the high to the low right here, notice, and this is pretty typical. I mean, I can show you this. There's lots of different places in the market where this happens over and over and over again. So what I'll do is sometimes I'll enter a trade after I see. So I'm looking for a move, a pullback, and then a move, and then another pullback, and then I'll enter right about here, okay? And then I'll trade this move up. Well, how long do I know how to stay in it? Well, I look for that 3.77% of the ratio of this first move, and look what happens. Just touches it. Now it touched it, pulled back, touched it again, pulled back, touched it again. But there might be a little bit more here left. But what I have found is that it's not worth taking the risk. I just use the 377. I come out of the trade, and that's that. Now, why is that important? You're not a trader. You don't want to do that. Blah, 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 blah. Okay? Let me show you why it's important. Let's look at this chart. And let's talk about this being the first move. Okay? And this is the pullback. Or I tell you what, let's look at the bond market, because we've already been talking about this first move and the first correction into the first move and so on and so forth. So here's the pullback, the big pullback in the bond market, and this was our first move, right? And then we bounced here, and it looks like we want to take off. So how far? So what are we really talking about in the bond market? How far could this thing really go? Well, let's see. Let's see. We just put it there. Come back to the pullback. We're talking about interest rates in pretty short order of 7.75%. Okay, so let's just say you had a bond fund, okay, and you're in it right now. Let's say you had $100,000 in a bond fund, and we had this move, and you just held on, okay? You're not going to sell it. You're just holding on for the long term because bonds are safe. And right now the interest rates are 2.186, and they move up here to the 7%. And let's say you had $100,000 in this bond fund. This bond fund, by the time you got to here, would be worth maybe $10,000, $15,000. That's how much money you would lose just in this move right here. So you can use Fibonacci to kind of estimate how far something might go. If we do that for the S&P 500. Now, again, let me stipulate, nothing is 100%. Don't send me a comment saying, oh, it didn't work. You have to be able to identify these important lows and highs, and then the first move and the first pullback in order to even know where to do the measurement from. So you might be saying to me, for example, okay, I'm going to do this measurement, but how do I know whether to measure it from here and how to measure it from here? That's a whole nother discussion, okay? And that's way beyond the scope of what we're doing here. I'm going to measure it. If you're going to ask me where I'm measuring it from, I'm measuring it from this first move here, because this is all overlapping and corrective, and that's why I didn't come all the way down here. So look at where the market went. Right there. I mean, now let me put the I'm going to show you why the 4.236 is also important. But this move right here, this is the next move off the first move down, the first correction back up, this next move down. This is pretty typical, okay? Well, I'm real close to just getting a whole can of worms, which I don't want to do at this point. But let me put the 4.236 back in here. 423.6. And then I'm going to redraw it from here to here. And if you go out, if you go out and buy the SDS next week, your target should be right here. This one, it won't show up on the chart because it's so darn low and I can't read it. What is that? 1,839. Okay. Now it could go lower than that. Okay, it could go lower than that. It could go to just beyond that. But this is a great, you know, if you're, the market's going to be moving pretty rapidly when it falls down through these zones, and there's nothing wrong with selling into strength. There'll be plenty of people willing to buy your stock if you're selling into strength, even if it goes down here. Okay, it's a great place to get out. So, for those of you that are interested in doing the you know, trying to make some money from the disaster, what is going to, you know, which is our market, then, you know, this is a great way to do it. It's not for everybody. I understand that. But for those that are interested in doing it, I want to make sure that we talk a little bit about it here. If you want to know more, you should probably try to contact me and let me know that you want to know more, and maybe we can work up some way to show you some things here. But I'll just bring it up from time to time here. It's not that hard to do. What's harder is to as it's fluctuating back and forth coming down here, for you to not chicken out and bail on your whole plan. You know, that's the more difficult part. Understanding how to read the charts is not that difficult. When you're looking at your P&L though, and it's up 1,000 and then down 500 and then up 5,000 and then down 3,000, you know, that's the more difficult part. So, which is why you need a plan, a trading plan, if you're going to trade. Anyway, that's about it this week, everybody. I've kind of rambled on here toward the end. You know, things are going to get really dicey in this market. I just hope that you'll promote this to your friends and family. And I know we don't have, but I don't know, half a dozen views, maybe 24 views, viewers out there. But my hope is that as things get a little bit more dicey, more people will start believing that that what I'm saying is actually going to happen, and then, you know, there's nothing like evidence to bring in a crowd. So, but that's it for this week. Please come in next week. Send a link to the video to your friends and family. You can also on Twitter, I'm at InvestorClass. I've been pretty busy lately, so I haven't been looking at Zero Hedge to see if there's any interesting articles there. But it seems like there's always something there that nobody else is reporting on. If I see anything this week, I'll certainly post it and tweet it so that people can see it there. All right. Thanks again, everybody. We'll see you next time.